That's better. That's better. Thank you so much for that. Thank you so much for that. So welcome to today's session. Yes, welcome to today's session. This is financial reporting, and we're going to look at investment property. Investment property. Investment property. Investment property. Thank you so much. Thank you so much. Thank you so much. So investment property is our area of focus today. Is our area of focus today. Investment property is our area of focus today. And this one is guided by IAS 40. IAS 40. IAS 40, International Accounting Standard 40. International Accounting Standard 40. Great. Now, in this area, we're going to look at some of the investment property, like a piece of land, or in a building, that its purpose is fully for investment and not used by the management, So we can start by saying that an entity may own land. An entity may own land. An entity may own land or building. May own land or building. May own land or building as an investment. May own land or building as an investment, rather than for use. Rather than for use in the business. Rather than for use in the business. It may therefore generate cash flow. It may therefore generate cash flow. Therefore generate cash flow. Largely independent. Largely independent of other assets. Of other assets. So even the entity that this property is giving us, even the cash flow that we're getting from the entity is different. It's independent from other what? From other assets that the entity have. From other entity that from other asset that the entity has. So what is the investment property? An investment property, it is a property into bracket, refers to the property into bracket, land or building. This is a property. Investment property, we say that it is a property into bracket, land and building, bracket, land and building, into bracket, land or building, just say land or building, land or building, land or building, or part of a building, or part of a building. It can be part of a building, or both. Part of a building, or both, or both, or both. You close the bracket, you close the bracket, then you continue and save, you continue and save. You close the bracket. Held by the owner, held by the owner, held by the owner, held by the owner, or the lessee, or the lessee, somebody who got the right to use that asset, or the lessee, to earn rentals, to earn rentals, to earn rentals, or for capital appreciation, for capital appreciation. So at the end of the day, class, you're able to see that we are generating revenue from this property. We are generating revenue from this property. Directly, we can get rentals. Directly, we can get rentals. We can also wait for the property to appreciate or to improve in value, and we shall be able to get what? We shall be able to get capital or some return from the property, some return from the property, some return. So for capital appreciation, rather than one, this property, the investment property, they are not used in the following. Their main objective is to generate rental for the owner, or to get the capital appraised or increased after some time. So rather than one, use in the production or supply of goods or services, use in the production or supply of goods and services, supply of goods or services. They are not used for these purpose. They are not used for this purpose. Supply of goods or services, or for admin purposes, or for admin purposes, for admin purposes, or for admin purposes. Number two, they are not for sale. They are not for sale in the ordinary course of business. Sale in the ordinary course of business. Course of business. So at any given point, class, you are asked about the investment property. Investment property. Those are some of the qualities, or characteristics. They are not used in the production. They are not used in the production or supply of goods or services for or for admin purposes. They are not also used for sale in the ordinary course of the business. They are not used for sale in the ordinary course of the business. Maybe the financial year of the company. Let's define owner's occupied property. Examiner will bring you one of the term and tells you to define owner's occupied property. Owners occupied property. Owners occupied property. Owners occupied property. You say that it is a property held by the owner. It is a property held by the owner. Owners occupied property. It is a property held by the owner. As the name suggests, owner occupied property. Yes, I know you have your own properties. It is a property held by the owner, into bracket, or by the lessee as the right of use asset. So the lessee owns that by the right of use asset. By the right of use asset. By the right of use asset. So that one, by the lessee or by the lessee, by the right of use asset, funga bracket. For use in production or supply of goods or services, or for admin purposes. Now this one is a property that you can use in production. You can use in production. It can also be used for admin purposes, right? They can also be used for admin purposes. So the owner's occupied property is different, is opposite of the investment property. Is opposite of the investment what? Investment property. So you say that the owner's occupied property can be used in the production. Owner occupied property can be used in the production of goods or services. It can also be used for admin purposes. For admin purposes. Kindly confirm whether we are together up to that point before we move to the next part. Before we move to the next part. Are we together really? Are we together? Sometimes examiner will bring you those terms to define. Now, these are more of the theories. Remember what we said? As far as our exam is concerned, theory part, we need just to understand the concept and then we apply. You understand the concept and then we apply. So let's define fair value. Asante, let's define fair value. What is fair value? I think this one we come across this term in our financial management. Also, in our financial reporting, we have come across the term fair value. So what is fair value? Fair value, it is the price that would be received. It is the price that would be received to sell an asset. It is the price that would be received to sell an asset. That is the fair value. The price that would be received to sell an asset. The price that would be received to sell an asset. All paid to transfer a liability to sell an asset. All paid to transfer, or paid to transfer, or paid to transfer a liability, to transfer a liability in an ordinary transaction, in an ordinary transaction between market participants, between market participants at the measurement date. At the measurement date. At the measurement what? Date. So that price that you may pay to receive either a service or an asset. Huh? It's referred to as the fair value. Measurement date. The fair value or the par value. The original cost of what? Of an asset. The original cost of an asset. Then what about cost? Let's define cost. What is cost? As far as this is concerned, what is cost? So for the cost class, we say that it is the amount of cash or cash equivalent. It is the amount of cash or cash equivalent. The amount of cash or cash equivalent paid. It is the amount of cash or cash equivalent paid. The amount of cash or cash equivalent paid. That is what we call cost. Cost. The cost incurred. The cost incurred. The cost incurred. That amount of price paid. All right. Then we have the carrying amount. We have the carrying amount. It's not a new term. We have come across this. Carrying amount. Another name of that you can give this. Another name. Carrying amount is the net book value. It is the net book value. The net book value. Carrying amount can also be referred to as the net book value. So you say that it is the amount at which an asset is recognized. It is the amount at which an asset is recognized in the statement of financial position. You see? Carrying amount. The amount at which an asset is recognized in the statement of financial position. The statement of financial position. So we call those carrying amounts. Call them carrying amount. So class, we can have examples of investment properties. It's good to have some examples of investment property. Examples of investment property. Examples of investment property. Number one, or part A. So if the examiner asks you to give him or her some examples of investment property, please remember that we have part A or number A, land held for long-term capital appreciation. A, land held for long-term capital appreciation. Land held for long-term capital appreciation rather than for short-term sale in the ordinary course of the business. For capital appreciation rather than for sale, for short-term sale. Rather than for short-term sale, in the ordinary course of the business. In the ordinary course of business. So that one falls under the example of investment what? Investment property. Examples of investment property. Number two or part B, Part B, a building owned by a reporting entity. A building owned by a reporting entity. A building owned by a reporting entity and leased out under an operating lease. Owned by a reporting entity. So this is part B. A building, very important, owned by a reporting entity. A reporting entity, a building owned by a reporting entity and leased out under an operating lease. And leased out under an operating lease. You know, you have two types of leases and you know them different. You are able to differentiate. You're able to differentiate the two, the operating lease and the second one is the finance lease. The operating lease and the finance lease. So that will form part of what? Part of the investment property. Investment property. The next one, part C, is a building held by a parent. A building held by a parent company and leased to a subsidiary. That will also be part of what? Investment property. So if a parent company own a certain building and then lease it to the subsidiary company, that building will be an investment property. Will be an investment property. That building will be an investment property. Then the last one, but not the least, property that is being constructed. Property that is being constructed, that is part D. Property that is being constructed or developed for future use as an investment property. So if you have a property that is ongoing, and it is not yet complete, and in future will be used as the investment property, fall under the examples of what? Investment property. So the last one, we have said that it is the property that is being constructed or developed for future use as an investment property. And that is it. That is it as far as the examples are concerned. We have the form. Then we can maybe highlight. We can highlight. This one, don't even write down. You can just understand them. Just understand. Get the concept. Examples of items that are not investment property. Now, we have looked at the examples of investment property. Let's look at examples of items that are not investment property. So the following, whatever that I'll read here, are not part of what? Investment property. Number one, property intended for sale. Property intended for sale in the ordinary course of business. For example, we have inventory. Inventory, stock. Remember, once we purchase, once we acquire stock, the main intention is to sell stock so that we can get profit from it. Therefore, property intended for sale in the ordinary course of business. There is the difference between the fair value and the value in use. And that's why we say fair value, the one we define fair value somewhere. Fair value is not the same as value in use. Fair value is not the same as value in use. That is according to IAS 36. That is in regard to impairment of assets. So fair value is not the same as value in use. Fair value is not the same as value in use as far as IAS 36 is concerned. So I think it is important for us to know what fair value reflect in and the value in use also guide us on. So let's start with the value in use. Value in use. The value in use. We are trying to differentiate or to try to understand between the two. Value in use. And then we have the fair value. See, those according to IAS 36, you're saying that they're not the same. The value in use and the fair value. Value in use and the fair value. So what is the value in use? Say that reflect factors, it reflect factors, and knowledge specific to the entity. Reflect factors and knowledge specific to the entity. Specific to the entity. Specific to the entity. Yeah. So for the value in use, you're trying to look at the specific factors, the knowledge to the entity. What about the fair value on the other side? Reflects factors, and knowledge relevant to the market. Now for the fair value, hope it's visible, fair value. So it reflects factors and knowledge. Relevant to the market. So one is for the entity, the other one is for the interest of what? The market condition. And we know that when you are trying to determine the fair value as an institution, as the entity, you should not double count the fair value. You should not double count any asset. Don't double count any asset. Don't double count any assets. NB. So we say that when the lease payments are at market rate, the fair value of an investment property held by RC, let me just write it down, NB, when the lease payments are at market rates, when the lease payments are at market rates, the fair value of an investment property held by RC as a right of use asset net of all expected lease payment. Should be 0. So when the lease payments are at market rates, the fair value of an investment property held by RC as a right of use asset, net of all expected lease payments, should be 0. That's an NB as far as the fair value and the market value are concerned. So one is in regard to the market knowledge and also the factor. The other one is in regard to what? The entity, knowledge, and factor. 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 So we have a model. We have a model that models that can be used. The first one is a cost model, and the second one is the fair value model. So we have two models that can be used to sort the two. So the first one is the cost model. So under the cost model, you find that the cost model as described under IAS 16, it is for the owned asset. It is for the owned asset. For the owned assets or the leased asset. The leased asset. So you can write and say cost model in IAS 16 for owned asset. It is for the owned asset. These are assets held by the lessee. These are assets held by the lessee. Asset held by the lessee. Asset held by the lessee as right of use assets. As right of use assets are measured at cost. Measured at cost in accordance with IAS 16 leases. This it's IFRS. This is IFRS. IFRS 16. IFRS 16. Accordance to IFRS 16. IFRS 16. Point number two, investment property should be measured at depreciated cost. Investment property should be measured. Investment property should be measured at depreciated cost. Should be measured at depreciated what? Cost, comma, should be measured at depreciated cost, comma, less any accumulated impairment losses. Less any accumulated impairment losses. Less any accumulated impairment losses. NB, it's good to know this, that an entity that chooses to use a cost model, an entity that uses or chooses to use cost model should disclose the fair value of its investment property. It should disclose the fair value of its investment property. That is a requirement, disclosure of the investment property. If you choose to use the cost model, you will be required to disclose the fair value of your what? The investment property. So any entity or every entity is encouraged to either stick to the cost model or the fair value model. You can use one, you cannot use two. You can use either one of them. And use one of them. Recognition. How investment property recognized. Recognition, we're almost winding it up. We're winding these up. We're winding it up. Once we get to the recognition, come easy. Recognition. So for the recognition, investment property should be recognized as an asset when two conditions are met. That is important. So investment property. Remember, we say that this is an item which is there not for production, not for sale. But we want it appreciate after some time. So when it comes to recognition, it can be recognized as an asset. It can be recognized as an asset through several conditions. Condition number one. It is possible that the future economic benefit that are associated with the investment property will flow to the entity. Get that? So if the future economic benefit will get back to the entity, at that point, we can say that the investment property in subject is an asset. If that does not apply, it's never an asset. So I repeat. Investment property should be recognized as an asset when two conditions are met. Condition number one, it is possible that the future economic benefits that are associated with the investment property will flow to the entity. If the future economic benefit, sure that it is flowing back to the entity. Number two, the cost of investment property can be measured reliably. If the cost of investment property, The cost of investment property can be measured reliably. If the cost of investment property can be measured reliably. If the cost of investment property can be measured reliably, that we say it is actually what? It is an asset. Be able to measure the cost, it guarantee the item to be called an asset. So fair value model, let's just have something under the fair value model. The fair value model. The fair value model. So after initial recognition, an entity that chooses the fair value model should measure all of its investment property, should measure all of its investment property, at fair value. Except in extremely rare cases, except in extremely rare cases where this cannot be measured reliably. Where this cannot be measured reliably. Where this cannot be measured reliably. So in such a case, you use the cost model. A cost model. Transfers. Transfer. How does transfer happen under this? Transfer. So for the transfer, we say that transfer to or from investment property should only be made when there is a change in use. So transfer to or investment property or transfer of investment property should only be made when there is a change in use. The transfer should only be made when there is a change in use. Transfer will only happen when there is a change in use. When there is a change in use. Transfer will only happen when there is a change in use. For example, if the owner occupies occupation commences. For example, if the owner occupation commences, if the owner occupation, if you are the occupation of the property commences, the occupation of the property commences, that will be treated as what? A transfer. If you give the lessee the property and they start using it, that will be part of what? That will be a part of a transfer. That will be part of 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 transfer. Then we look at disposal or derecognition. Disposal or derecognition. Disposal or derecognition. Disposal or derecognition. Now, for the investment property, so if it was recognized as an asset, now how do we eliminate it? Or derecognition of investment property. Disposal or derecognition of the investment property. Derecognition refers to elimination from the statement of financial position. Refers to elimination from financial, a statement of financial position. So when we say that an investment property has been derecognized, investment property has been derecognized. This happens, derecognition happens when the investment property is permanently withdrawn. It happens when the investment property is permanently withdrawn. When the investment property is permanently withdrawn from use. Withdrawn from use. And the future economic benefit are expected from its disposal. So at the end of the day, we are recognizing if the investment property, whatever that investment property is expected to bring, the benefits are coming from the disposal of the same. So at that point, we say that we have derecognized that item. Derecognized that item. Derecognized that item. Any gain or loss on disposal, is the difference between the net disposal proceeds. Any gain or loss on disposal is the difference between the net disposal proceed and the carrying amount. So you look at the carrying amount or the net book value of that investment property, and then you check or you look at it, net disposal proceed, net disposal proceed. The difference there is either gain or loss, gain or loss, gain or loss. So to get the gain or loss, you have to look at the difference between the two. So the gain or loss can be represented. It can be accounted under the statement of profit or loss. Statement of profit or loss. If it's the gain, that's an income. If it's the loss, that's an expense. That's an expense. NB, note better. Compensation from that party. Compensation from that party. Compensation from third party. Compensation from third party. For investment property, for investment property, for investment property that was impaired or lost, that was impaired or lost, or given up, shall be recognized, in profit or loss when the compensation become receivable. Become receivable. In the compensation become receivable, and the compensation become receivable. So the final part under this class will be disclosure requirement. So let's have a few minutes break. Let's meet by 6:07. 6:07 itakuwa sawa. Disclosure requirement will be the next requirement. So for the disclosure requirement, we say that they relate to, or these relate to one. These relate to Roman number 1, choice of fair value model or cost model. Or cost model. That is 1. Number 2, criteria for classification as investment property. Number 3, assumption in determining the fair value. So you need to have some assumptions. The fair value. Assumption in determining the fair value. The fourth one, the disclosure number 4, is use of independent professional valuer. Something else that you need to disclose as an entity. What you need to disclose is the rental income and expenses. How much are you getting? Rental income and expenses should also be disclosed. And the last one is any restriction or obligation. Any restriction or obligation. Any restriction or obligation should also be disclosed. So those are the 6 area that form the disclosure requirement. 6 area that form the disclosure requirement. The 6 area that form the disclosure requirement. So finish up and then confirm once you're done. Just finish up and then confirm once you're done. Just finish up, then confirm once you're done. Then we proceed. Once you're done, just type Y for yes, or D for done, or D for done. Any can do. D for done or Y for yes. Are we done? Are we done? Are we done? Now to move to the next thing. All right. Lugha amemaliza. That's better. Leo mtu amemaliza hapa. Somebody was asking for the link, jameni. Oops. No. There's some people who did not manage to get the link today. What happened? People did not manage to get the link today. So people are done with that. Okay, now. Sorry, hata tukiwatumia jameni. Okay, good that we are recording the video. So class, that is it as far as the syllabus is concerned. So let's look at some of the areas that we need to concentrate on as a part of revision. So group consolidation. Cash flow statement. We also need to look at conversion. Conversion of a partnership into a limited company. Conversion of a partnership into a limited company. That's also, there's an area that they have not tested for so long. The area of the agriculture. Hiyo area hawajatesta mikaka kidogo. That is farm accounts. Is it this farm or the other farm? Ni farm ama ni ile ingine? Farm. Is it this one? Or the other one? Farm account. Is the other one? Yeah, it's the other one for A. Yeah, it's the other one for A. Farm account. Yeah, farm accounts. This one, we shall remind ourselves. So make sure that you're also looking at what we have done. Because revision is just to make it be at the top of our mind, to remind ourselves. So Is it so? Any other area that you think, okay, published account, published. Published account, public sector accounting. Also, you need to look at public sector accounting. These are areas that you need to concentrate on. Public sector accounting, public sector accounting. Then, the topic number one, you've seen topic number one have several subtopics. It has a lot, right? Has a lot. So the short answer questions come from, in most cases, they come from topic number one, theory, sana. Then we shall look at how we account for inventory. That one, we shall have to look at it, how we account for inventory. Yeah, remember inventory, this is an asset. How do we account for inventory? That one we shall look at it. It's just a simple concept. Simple concept. When you've been given inventory at cost, and when you've been given inventory at net realizable value, which value now do we record? Which now value do we record when you're given the two value, net realizable value and at cost? So shall be looking at it. So any other area that you feel that we also need to look at from your end? Question on investment in associates and a joint venture for some of us who missed okay. Yeah, so at a group consolidation, yeah, joint venture in associate. Yeah, that's good. Thank you. We shall, under that, we shall look at that question. Investment in associate and joint venture. Maybe to remind you, we say that at any given point, examiner give you 3 companies and a group consolidation amepatia kampuni tatu. So the first thing is to identify the group structure. That is the first thing. You identify the group structure so that you're able to tell, this is my parent company, this is the subsidiary, and this is what? The associate. And how we account for the associate and the joint venture is the same, right? How we account for the two is the same. Guided by IAS 28. Whereby we shall be using the equity what? The equity method. You know, between the two, we only need 2 things. Or maybe to say 3. 3. The first one is impairment of goodwill. If we have impairment of goodwill or in goodwill, we usually add it under the admin expenses. It increases the admin, so we don't leave that behind. Then we also need to look at the profit share. And the profit is always at the income statement. You look at, you'll see it, profit after tax. That is what you're going to share. How many months did we stay with this company, this subsidiary or the joint venture? That's the key. We stayed with this joint venture for 6 months. Therefore, what is the profit? What is the profit we generated when together? What is the profit we generated when we are together? And then, what percentage of acquisition did the parent company take from the associate? So some of the things that once you understand them, it will become simple. Remember what we said. For the group question, it's a severe question. This is a question that you can get 19 out of 20. 15, the worst. 15 out of 20. But you need to first of all analyze it. Then investment in associates. Taken to taken to our balance sheet. It is a non-current. It is a non-current asset. What of his of mock exam where it was acquired in 20, and we are reporting at 2022? Yes, a good one. Good one. If we get time, we shall even review that mock together. So, who did we say? I know most of us can help us in that. When the company, it be the subsidiary or the associate, was acquired some years back, and the reporting or the current year of the reporting is maybe 2024, 2023. What did we say? What happens? There is an assumption there before you get to the advanced level whereby you now need to compute together the depreciation and such. But at our level, we said something very important as far as that is concerned. Usema namna gani? Somebody? If the acquisition took place some years back and the reporting is either this year or last year, kama venye wamesema vizuri 2017 and 2022 is the reporting. Class tunasemaje? We said something. We assume that the acquisition take place at the start of the financial year of the parent company. Financial year of the parent company. So you look at what is the reporting date of the parent company, because in most cases, examiner will not give you the start of the start year or the start date of the financial year, right? The examiner will give you the end date. And when you're given the end date, always note that you take it back 12 months to know the start date. You take it back 12 months to know the start date. So that start date will be the acquisition date. In such a case, class, are we supposed to apportion the items of our subsidiary company? Are we supposed to apportion the items of our subsidiary company in such a case where the acquisition takes place at the start? Are we supposed? We are not supposed to. We're not supposed to apportion. We're not supposed to apportion because whatever revenue, whatever expense that was incurred, it was incurred for the whole year. It was incurred for the whole. So any activity that took place, it took place when we had this company. It took place when we had this company. Even if I multiply by 12 over 12, it will remain the same. It will remain, there will be no change. 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 Another thing that you need to be very keen, is the cash flow. The cash flow statement. Cash flow statement, let's be very keen on it. Let's be very keen on it. Let's be very keen on it. Just remind yourself of the three activities. Remind yourself of the three activities. Three activities under cash flow. Just remind yourself of the three activities under cash flow. Of the three activity under cash flow. Then published account, preparation of published account or published statement. This is also important. And we said that if you're not very comfortable with the published account question, if you're not very comfortable, please don't start with it. This is a question that can take 2 hours to solve. This one, it can take 2 hours. So this one, you can take 40 minutes. So if I have a question that is taking me 2 hours to solve and get the correct answer, and I have a question that I can do within 40 minutes, which one should I start with? Automatically, the one that I can finish very fast, right? Remember, we're having 20 marks hapa na hapa iko 20 marks. So you're using 20 marks to get the 20 marks, 2 hours to get the 20 marks. I'm using 40 minutes to get the 20 marks. Who is at a good position of passing that paper? Who is at a good position of passing the paper? Time is a factor. Time is a factor here. Here you don't have more time. You have only 3 hours. You have only 3 hours. Therefore, please start with a question. As you do your exam, start with a question that will give you what? That will give you more marks, and you use less time. Less time. So hii sana sana we encourage students to do it as the last question. As the last question. Why are we doing it as the last question? Even after theory. Why are we doing it as the last question? It is the question that requires you to compute. Like, the examiner will not give you the cost of sale, right? So you need to remember. Hapo utapewa cost of sale. Hapo ndipo utapewa what I was saying that this one, how to account for the inventory. Hey. So please be very keen. Be very keen when you are analyzing. We say that the first 10 minutes as you do your exam is to analyze that paper. And that does not mean that you are wasting time. No, that will save you big. So we say that under published account, this is IAS1, but by 2027, this one will change. The standard is changing to IFRS. He's saying that under this, examiner will not give you cost of sale. Revenue utakupatia vizuri. Chenye unaweza pata hapa direct ni revenue hapa. Revenue utakupatia direct. Anaweza kupea direct. And sometimes they give you revenue, and then in the additional information, they tell you that it was inclusive of a certain value. So you have to find it. You have to find it. So if you're not given the cost of sale, you have to compute. How do we get the cost of sale? Cost of sale have several components. Who can give me the first component? Who can give me the first component? Anaweza nipatia component ya kwanza. Components that make purchases. Yes, purchases. So we have inventory. And of course, this is opening inventory. Right? Then you have to add purchases. Add purchases. Add purchases. Add purchases. What affect purchases? Na mtu nimeona ametuambia carriage inward. Carriage inward. What affect purchases? Is it the carriage inward? Hizo carriage inward sana sana wana first foundation level. Return inward, return outward. But in the case you given, now if I add purchases, then I let me the closing inventory. Closing inventory. Then whatever this is covers. Then we get our cost of sale. There are other things like depreciation which affect this. I don't want to go that route. But during our revision, we must get this. What I want to show you is that under this topic, there are a lot that you need to do. There are a lot that you need to do before you arrive to the exact thing that you need to get. you need to do some workings. So to proceed in this question, some workings are needed. Some workings are needed. Some workings are needed. Some workings are needed. So when it comes to the inventory, which also affect these one, you see, like our closing inventory. Assume you are given two values. Inventory at cost, naambiwa kwamba ni 700,000 or 70,000. And then inventory at net realizable value. Inventory at net realizable value is 60,000. Which one will you use? Hapo. You're given the two. Examiner amepatia mbili. Amekwambia tu hivyo. Utatumia gani? Utatumia gani? Which one is the best to use at that point? That point. Class, which one? The best to use. Ivona Sombia, we use the 60,000. Okay, let me wait for the rest. Inventory. Somebody else. At cost. Miratombia at cost. Unaitumia at cost. Haya. At cost. $60,000, Kevin. Okay, sawa. Please. Before even we look at it, let's go and do some research on the same. How to account for inventory. In most cases, we say that always go for the lower of the two. So we shall be looking at that as well. Lower of the two. All right. Now, according to this list here, class, where do we start? Where would you wish us to start? Because we shall be starting our revision. Tuanze wapi? Just this one is 1, 2, 3, 4, 5, 6, 7. Tuanze number. Okay. Aya. Watu ambia tuanze. Nasema sasa tuchape kabisa, and then our speed should be okay. So tuanze gani? Publish account. Aya. Published. Tunataka tufanye maswali either mbili. Ama for the sake of time we can be doing one published. So naona cash flow published. The last one. Cash flow published. So that means in our revision we shall start with question from no, that is not cash flow. From published and cash flow. Kindly. That's what we have said. Please, you have the link to the past papers. Before we meet, please look at some questions from cash flow and attempt. Some questions from published account and attempt. I can share, if time's allow, I'll share with you in the course of the day, or either tomorrow. Can share some questions for you to attempt. And then once we meet on Thursday, we shall be looking at the two. But for today, class, I want us to stop it at that point. course, even if I start the cash flow now, we shall not finish. We shall not finish. So I want us to end it at that point, and then we meet on Thursday. We meet on Thursday. We meet on Thursday. So continue practicing. Continue practicing. They say that practice, practice, make perfect. Practice, practice, make perfect. The small error or the little error that you're making now, they can only be resolved. They can only be resolved by doing it severally. By doing it severally. Any question? Any question? Any question? Do we have any question? Do we have any question? All right. Results of the MOOC. Yes, I'm still marking. I'm still marking Weni. I'm still marking. I have several. Niko na za AFM, niko na FM. So I'm still marking. I'll give you feedback. If not this Thursday, next week, Tuesday, I'll just give you your position. Takwambia uko wapi. Most probably this week. Sababu sasa next week tutakuwa tunakaribia mtihani, so most probably this week nitakwambia penye tumefika. Asante. All right. Let's wait it at that point. Thank you so much for sacrificing for today's session. May you all have a blessed day. Goodbye.